All right, let's just jump right into this explainer. Today, we're putting Napco Security Technologies through the ultimate investment gauntlet. We really want to find its true intrinsic value. We're going to strip away all the market noise and look at this exact business through the eyes of the absolute legends of investing.
So, here's our roadmap for today. We'll look at the company snapshot, apply the Buffett lens, the Lynch lens, the Graham lens, do a raw DCF valuation, and finally, bring it all together for a synthesis and final recommendation. Let's get to work. Section 1. The NSSC Company Snapshot. Okay, so Napco, ticker symbol NSSC, is currently trading at $37.39. They've got a market cap of around $1.3 billion. Now, they're a major player in electronic security equipment. We're talking access control, fire alarms, locking applications, that sort of thing. But here's where it gets really interesting. The real story is the massive business transformation happening under the hood right now. They are actively pivoting away from standard kind of lower margin hardware sales and moving straight into high margin recurring service revenue, or RSR. This is heavily driven by their StarLink communicators and cloud platforms. And get this recurring revenue is approaching a $100 million annual run rate at a literally incredible 90% gross margin. I mean, for an investor, that is the absolute holy grail. It completely changes the company's DNA into a highly predictable cash machine.
Which brings us to a really crucial question. Does this awesome software-like transition actually create the kind of high-quality business that Warren Buffett would want to own?
Section 2. The Buffett lens. So we all know the Oracle of Omaha famously loves a high return on equity and super low debt, right? Because that proves management is actually efficient with their capital. Well, Napco delivers a really stellar 20.35% return on equity. And honestly, even better than that, their debt-to-equity ratio is just 0.03. To put that into perspective, that is practically zero debt. In today's high-interest rate environment, having a pristine balance sheet like that is just a massive structural advantage. So, running through the rest of Buffett's quality checklist, those sticky 90% margin cloud services, they absolutely provide a wide economic moat. Why? Because once these systems are installed by the pros, the switching costs are just incredibly high for the customer. And when you factor in an estimated owner earnings, or free cash flow, of around $56 million, NSSC easily passes Buffett's quality checks. But, being the strict value investor he is, Buffett would definitely demand a 20% margin of safety on that price before he'd even think about initiating a position. All right, let's shift gears for a second. How would the growth at a reasonable price legend himself, Peter Lynch, view this exact same setup? Section 3. The Lynch lens. Looking through Lynch's framework, he'd probably categorize Napco as a fast grower that's actively transitioning into a highly profitable stalwart. But what's really fascinating here is the institutional footprint. Now, Lynch loved finding stocks before the big money piled in, right? Well, actually, the smart money is already arriving. We're seeing massive institutional buying from top-tier funds. Fundsmith just added $35.4 million recently. And we're seeing steady accumulation from the quants over at Renaissance Technologies, too. However, Lynch was an absolute stickler for the PEG ratio. The price to earnings divided by the growth rate. So if we calculate NSC's PEG ratio by dividing its PE of 36.28 by its recent 15.4% recurring revenue growth rate, we get 2.35. Now for Peter Lynch, a PEG of 1 is fair value. So at 2.35, the math is basically telling us the stock is fully priced for its growth narrative. That makes it much more of a hold in his playbook, rather than a screaming buy. But hey, what happens when we strip away all that flashy growth narrative entirely and just apply the cold, hard, quantitative metrics of Benjamin Graham? Section 4. The Graham lens. So Graham doesn't really care about cloud services or 90% margins. He cares about hard assets. While Napco definitely passes Graham's tests for adequate size, amazing financial condition with a current ratio of almost 5, and long-term earning stability, it literally utterly fails his valuation checks. Graham firmly wanted a PE under 15. Napco is sitting way up at 36. He wanted a price to book under 1.5. Napco is at 7.51. Yikes. To find out what Graham would actually pay for this business, we have to use his classic intrinsic value formula. It's the square root of 22.5 times earnings per share times book value. So we just plug in their EPS of $1.03 and a book value of $4.98. And the math yields a Graham intrinsic value of just $10.74. Yeah, that means at the current price of $37.39, the margin of safety is severely negative. A strict deep value investor wouldn't even touch it. But keep in mind, Grimm's formula naturally punishes asset-light, high-margin tech businesses, so we really have to view this particular metric with a grain of salt.
Section 5. DCF and quantitative valuation.
All right, let's leave the guru philosophies behind for a second, enter the quant room, and build out our own discounted cash flow model based purely on future cash. Because of that really powerful recurring revenue momentum we talked about earlier, we can confidently forecast a 15% free cash flow growth rate over the next 5 years. We'll set the terminal growth rate at a standard 2.5% and discount the whole shebang back to today using a 9% weighted average cost of capital. When we run all those assumptions against their current free cash flow generation, we get a base case DCF fair value of $40.58 per share. Basically, this implies the stock is actually trading at a slight discount right now compared to its future cash generating potential. But obviously, we can't rely on just a single scenario. That's why we run a sensitivity analysis. Running those numbers, even if we aggressively tweak the discount rate up to 10% or pull the terminal growth down to 2%, the intrinsic value still hovers comfortably right between $35 and $46. The math actually proves surprisingly resilient here, regardless of any minor macroeconomic shifts. And furthermore, applying other models completely validates our DCF. If we look at a comparable company analysis and apply a historically normal 30x EV/EBITDA multiple to their adjusted forward earnings, it triangulates a fair value between $40 and $45. So virtually everything is pointing to a very similar valuation zone.
Section 6. Synthesis and final recommendation.
Okay, it's time to bring all these numbers to the table and synthesize our final verdict on Napco. While Graham would obviously take a hard pass due to that massive price-to-book ratio, when we blend the insights from Buffett's high-margin moats, Lynch's sticky growth, and our own DCF outputs, it really suggests NSC is fairly valued to maybe slightly undervalued right now at $37.39. So our final verdict is a solid hold for current owners. But it would absolutely trigger a Buffett-style buy if market volatility somehow pushes it below that $35 margin of safety threshold. So the ultimate question I want to leave you with today, in a world where every single company out there claims to have a wide moat, is Napco's 90% margin recurring revenue the ultimate armor against an economic downturn? Think about that. Thanks for joining me on this explainer. Keep learning, and I'll see you next time.